Welcome, everybody. It is July 8th of 2025, and last Friday we got OB3. That's at least what I'm calling it. The One Big Beautiful Bill Act was signed into law on July 4th, which was Friday. And as of yesterday, the day before, we actually got the full text that was passed and signed into law, rather than all the different versions that we had seen over the past several months. There was the initial draft, there was the House version, then we had the Senate version, and now we have the final thing that was created and put into law. So, for now and for the next while, all of this new tax legislation, and I'll be breaking it down for you in the ways that it actually affects things, trying to translate as best as I'm able into everyday terminology so that people can understand what actually just happened. So, as a background, in 2017, there was TCJA, Tax Cuts and Jobs Act. That was the original Trump tax reform, which was passed on a 10-year time horizon, and a lot of stuff was expiring in 2025. Now, as it happens, or at the end of 25. So, as it happens, Trump was elected. Obviously, he was president 2017 through the beginning of 2021. Then we had Biden, and now we have Trump again. And Trump happens to be in office during the initial phase of TCJA and at the ending phase, which is historically unusual, but that's where we are. He was able to get this passed through the legislature and then signed so that his signature tax legislation is now extended because it was set to expire. What we're going to be doing here is going through and breaking down each individual piece. And there's a lot. We're not going to do it all at once, but let's just jump into it. So let's go to share screen. Screen one. Okay. Is this working? There it goes. And I know it's going to be hard to read here. Now, the whole bill is 870 pages, but we're not going to be doing the whole thing. We're just focusing in here on Title VII, which is the finance section, which has to do with taxes. So this is basically everything beginning with a 7 in the section numbers. And if you want to look at other stuff, there is plenty of other stuff, but here we're going to be focusing on that. So if we jump to page 216 of the bill, then we get into Title VII Finance, Subtitle A, Tax. And Section 7001, or 70,001 rather, incorporates all references to the Internal Revenue Code of 1986 and so on. So it's basically saying we are modifying existing law and then going forward. And if you've never actually looked at legislation before in detail, this is pretty much how everything gets worded. Blow this up so you might be able to actually read it. And you'll see here that like here in chapter 1, you'll see stuff like this. In general, section 1J is amended, 1 in paragraph 1, by striking quote, comma, and before January 1st, 2026, end quote, and 2 by striking, quote, 2018 through 2025, end quote, in the heading and inserting, quote, beginning after 2017. So basically what this is doing is this is changing the whole structure of this section 1J, and saying instead of how we originally passed it back in 2017 of being 2018 through 25, we're now changing the wording to saying beginning after 2017. Effectively, what this does is it creates a permanent change rather than temporary change, which is okay, fine. So Section 70,101, extension and enhancement of reduced rates. So what this is referring to is that rates were reduced by about 2%. At all brackets. So 39.6% went down to 37% and on down the road. Overall rates were reduced with Tax Cuts and Jobs Act, and now those reductions are made permanent, which is basically just changing the brackets that people pay tax on taxable income. And they're doing inflation adjustments. This was already a thing, so not such an issue, but each year the bracket thresholds get changed and the IRS puts out a publication and they're saying we're going to keep doing this, which is fine. Okay. Actually, before I go on here, so way back in the Stone Ages, when Tax Cuts and Jobs Act was first passed, people were very confused, and more importantly, HR departments were very confused. And so what ended up happening is that people's withholding was all screwed up. People heard on the news that, hey, I got this tax break, we passed this big bill and everything, but people were not seeing that in their tax refunds when they filed at the end of the year. And the reason for that is because what happens is that if you get a paycheck, a W-2 from an employer, then they do some back of the envelope calculations. They say, okay, if you make this amount and based on the filing status that you give us on your W-4, then we're going to project out and see what your taxable income would be and what your taxes would be assessed at. And for several years, even still today, screw up that calculation in light of the new tax legislation. And so what ended up happening is when people receive their take-home pay, there's very little intentionality when it comes to spending that take-home pay because they're used to getting X number of dollars as a tax refund at the end of the year. So they're like, oh, I get my $3,000 tax refund. But then when we have these big legislative changes, so maybe not, because maybe your withholding is reflecting the new reality. Maybe it isn't. Maybe your HR department is behind. Maybe your payroll processor is using the wrong tables. All kinds of issues came up. And so at this point, hopefully, most people have adjusted to the new reality. The W-4 was changed, I don't know, 5, 6 years ago into the new form because for a number of years, people were listing exemptions on their W-4, which no longer existed. So that was a giant issue. But the point is that when you earn money, especially as an employee, you want to have a mind towards what your annual income is, what your tax situation is going to be, and then you can figure out amount owed or refund or what have you. So ideally, on the front end, you would be making those calculations or working with a tax advisor to do those calculations and figure out what the real situation on the ground is. But the new situation is that the regime we've been in since 2017 is going to continue until Congress passes another law. And we get one about every 10 years. I'm sure the next administration or three will have some landmark legislation when it comes to taxes and change things around yet again. But for now, this is the lay of the land. Okay, so that's section 7101. Next section, extension and enhancement of increased standard deduction. So again, if you remember the old days, we used to get exemption based on the number of people, and we used to get standard deduction. So if you had 4 people in your household and each exemption is worth $4,000, you'd get $16,000 plus a standard deduction of about 12 grand if you were married filing joint. And so that totaled up to $28,000. So what they did in TCJA is they got rid of exemptions and they doubled the standard deduction. So for 2025, the standard deduction for a married joint couple is $30,000. And for a single person, it's $15,000. And for a head of household, I think it's $23,500 or $23,250, something like that. So what this is doing is, again, we're making TCJA permanent, and the new version of things is how it's going to be until Congress changes its mind sometime in the future. So that's 7102. Section 7103, termination of deduction for personal exemptions other than temporary senior deduction. So we're on the third part, and already we are into weird stuff. Okay, so this is the usual changing the dates. So now we're making Tax Cut and Jobs Act permanent, getting rid of those exemptions. And however, new subparagraph, deduction for seniors. In general, in the case of a taxable year beginning before January 1st, 2029, so that's going to cover 25, 26, 27, 28. So those 4 years. There shall be allowed a deduction in an amount equal to $6,000 for each qualified individual with respect to the taxpayer. What is a qualified individual? For purposes of Clause 1 or Clause I, the term qualified individual means the taxpayer if the taxpayer has attained the age 65 before the close of the taxable year, and 2, in the case of a joint return, the taxpayer's spouse if such spouse has attained age 65 before the close of the taxable year. So for 2025 through 2028, if you reach age 65 or greater by 12/31 of that year, you are qualified for this additional $6,000 deduction. And there is a limitation based on modified adjusted gross income. In general, in the case any taxpayer for any taxable year, the $6,000 amount in Clause 1 shall be reduced, but not below zero, by 6% of so much of the taxpayer's modified adjusted gross income as exceeds $75,000, $150,000 in the case of joint return. What is modified adjusted gross income? There are several different places that modified adjusted gross income is used, and they're usually fairly similar. In this case, it's saying the taxpayer adjusts the gross income. So you'll have on your tax return, you'll have taxable amounts on the right-hand column. But sometimes there are non-taxable amounts. Sometimes there's municipal bond interest, or there's foreign earnings, like from just foreign or Puerto Rico earnings, or something that is not necessarily taxable directly to the US federal. So they add all those back. And that is your modified adjusted gross income. And that is the testing amount for the $75,000 or $150,000 threshold. You have to have a social security number, and this has always been a big push with Tax Cuts and Jobs Act, and subsequently is that all of these credits and all these deductions require a Social Security number. So people who have ITINs are not qualified. And then married individuals, yada yada. Omission of correct Social Security number treated as a mathematical or clerical error. That's for penalty purposes. If you screw that up, they're not going to throw you in jail, which is great. And yeah, so this is the no tax on Social Security section, which is a gross simplification. Okay, so what about when I talk about the right-hand numbers? So here's just a fictitious tax return, and this person is single, was at least age 65, and had $30,000 of Social Security benefits. So you'll notice that nothing in here addresses the taxability of Social Security benefits in the first place. So the way the math works is that Social Security benefits get tested against total income. And again, there's that Magi add back situation. And then a percentage of that Social Security income may or may not be taxable. So in this case, if Mr. Sample here has Social Security benefits of 30,000, that's the only income. None of it is taxable. Because if you go through the worksheet, which I won't bore you too much with, is that it fails the threshold test, and so zero becomes taxable. Now, but what if Sample had a other income? Let's say we've got, oh, I don't know, let's say there's a pension, right? And let's say that pension has a $75,000 distribution, of which the whole thing is taxable. So then we refresh here, and now, because of this other income, 85% of the Social Security benefits became taxable. So on the front end, we have this sliding scale adjustment of how much of Social Security is taxable. And then if the modified adjusted gross income is for a single person over 75,000, then we're going to get a reduced additional deduction of 6,000. So you can see here that we have between 75,000 of pension and 25,500 worth of Social Security benefits. Then our total taxable income, or sorry, our total adjusted gross income is 100,500. Now, for Magi purposes, they're going to add in the other 15%, the other 4,500 bucks. So this is going to turn into 105 for Magi purposes. And then we're going to get our standard deduction. And then there's going to be a new extra deduction here. And every year, the IRS comes out with new forms. And obviously, it's going to be, if history is any guide, it's going to be down to the wire and maybe past the 12/31 real due date that the IRS updates all of their forms and gets them into a final form so that all the software providers can then create the forms that we can then use. So we have to imagine what it's going to look like at this point. So we're going to have adjusted gross income. We're going to have modified adjusted gross income, which is going to be a little bit more in this case. We're going to have standard deduction or itemized if that person's able to itemize. And then we're going to have this senior exemption, your senior deduction of up to $6,000 per person. So if there's two people, it could be $12,000 potentially, assuming modified adjusted gross income is less than 150,000. And if you look back here, that where was it? Yeah, shall be reduced, but not below zero, by 6% of so much of the taxpayer's modified adjusted gross income as exceeds $75,000. So what does that mean? That means for every $1,000, the modified adjusted gross income is above 75. That means that 6,000 is going to be reduced by 60 bucks. Okay, so if we do a little math, what does that mean? That means that if we got 6,000 divided by 0.06, so at 175,000, because it's going to be 100 beyond the $75,000 threshold, that additional deduction is going to disappear. So if you are a married filing joint couple, it's going to be $250,000, at which point that extra deduction goes away. And we have the $75,000 threshold, the $150,000 threshold, and then the phase out. And then after that, it's going to be zero. So when you're doing your 2025 tax planning or tax estimations for your senior folks who are 65 or older as of 12/31/2025, and this is going to be true from 2025 through 2028, then we have to keep in mind whatever this new phase out threshold is. And so that's the new quote unquote no tax on Social Security. You can see that it's not really no tax on Social Security. This is just, it's going to exempt the majority of tax on Social Security for the majority of people who receive Social Security benefits. But it's not a blanket wiping out of the Social Security benefits being taxable. So it's a two-step that helps most people in most circumstances. So if you're a high earner, then you're still going to be paying taxes. That's just how it is. So that is the senior, or how do they phrase it? Termination of deduction for personal exemptions other than temporary senior deduction. And there's a lot of stuff in here. This is this temporary 2025 through 2028 kind of language. We'll go through those as we find them. All right, next section, or not section, it's, oh no, it's section 70,104, extension and enhancement of increased child tax credit. The child tax credit, if you remember from the old days, was $1,000, and then it got bumped up, and then during COVID it went really high, and they were issuing payments to people's bank accounts, and then they brought it back down. So this is the new framework that we're working with. This is the same language that we've seen about making it permanent and eliminating the 2025, 2026 expiration, and striking 2000 and inserting 2200. So that's going to define the max benefit of child tax credit. Now, child tax credits are for children birth through 16. Once they turn 17, they become other and can be worth now up to $2,200, which is great. The more the merrier here. All right, Social Security number required. Again, this used to be available for children who had ITINs, not any longer, and that is going to remain not any longer. Everybody has to have socials, basically. And let's go inflation adjustments. Now, this is really different. So I don't know for how many years. The child tax credit was $1,000 flat just for decade plus. And then it went to 2000, but now they're saying that there's going to be inflation adjustments, which is fantastic. So many terms in the tax code are not inflation adjusted, and then we end up with ridiculous situations 30 years later. There's two portions to the child tax credit. There's a non-refundable portion and there's a refundable portion. So non-refundable reduces the amount of tax liability that you have. So if we go back to Mr. Sample here, you can see here that there's a tax liability of $13,528. Now, how much he owes or gets a refund is going to depend on how much was already paid and what kind of credits are involved. But that's the tax liability. So the non-refundable portion shows up here, and it reduces the tax liability on the front end. The refundable portion is that even if this goes to zero, then the refundable portion is going to show up down here, and that's going to give you money back, even if you didn't owe anything. And not even didn't owe additional, but didn't owe anything at all. So if you have zero tax liability, you can still get money back from refundable credits. So the child tax credit is split, part non-refundable, part refundable. And so the refundable portion was $1,400, and now they are inflation adjusting that as well. So yeah, maximum amount of refundable credit in case of taxable year beginning after 2024, the $1,400 amount in subsection H5 shall be increased by an amount equal to A, such dollar amount multiplied by B, the cost of living adjustment determined under section 1F3 for the calendar year in which the taxable year begins, determined by substituting 2017 for 2016 in subparagraph A2 thereof. So basically, every year the government issues a cost of living adjustment. This affects Social Security, it affects all kinds of stuff. And the total credit and the refundable portion of the credit are both going to be inflation adjusted going forward, which is great. And they're going to round to the nearest 100, which is helpful. Okay. Again, everybody needs Social Security numbers. So that's the change to the child tax credit. It's bumping up from this year from 2,000 to 2,200, and going forward, going to be inflation adjusted from that 2,200, of which 1,400 is refundable. Okay. Section 70,105, extension and enhancement of deduction for qualified business income. Okay, so qualified business income. This concept was created during TCJA, during Tax Cuts and Jobs Act 2017. So qualified business income is going to be things that are pass-through income, basically. S corps, partnerships, real estate, sole proprietor, farms, all kinds of stuff can be qualified business income. And similar to what we saw with the senior exemption or senior deduction, whatever they're going to be calling it now, is that depending on your filing status, there's a threshold below which you get a flat 20%, and above which you had a phase-out period. And once you finish the phase-out, then it was fully tested against 50% of wages or 2.5% of assets, which is the UBIA. It's an unadjusted basis. Can't remember what IA stands for, but so that phase-out threshold was 50,000 for single, married filing separate, and head of household, and it was 100,000 for married filing joint. And or sorry, the phase-out range was that. So you hit the threshold, which changed every year. I think this year is 184,000 for single, separate, and head of household. And for married joint is 380, something like that. So now they're changing the phase out window of 75,000 from 50,000 above the threshold to $75,000 the threshold for everybody except for married filing joint. And the married filing joint phase out window is going from 100,000 to 150,000, which is useful. Okay, minimum deduction, which is you're going to get a minimum of $400 deductions if you have qualified business income at all, and that's taxable. If you're running losses, then no. But yeah, so you basically have to have at least $1,000 worth of qualified business income. Active trader business, this was a whole thing that was being debated as to, because there are two different categories of what businesses qualify, because there are certain categories which are specified services trader business, SSTBs, and basically that disqualification remains. Accountants, law firms, there's a list of basically people who make a lot of income in typically service businesses that are specified service trader business. They are not going to get QBI treatment if they're over the threshold. And again, they're inflation adjusting, which is great. Cost of living adjustments, section 1F3, yada yada yada. And yeah, so this one begins 2026. So this minimum amount, the phase out threshold, the phase out windows above threshold, and that $1,000 minimum in order to get any QBI, this is going to apply 2026 going forward. Okay. Section 70,106, extension and enhancement of increased estate and gift tax exemption amounts. So this doesn't apply to a lot of people, but for the people who does apply to, it's fantastic. So again, in the old days, there was an estate tax exemption, right? And it was round about $5 million. And then Tax Cut and Jobs Act basically doubled it, and it got up to 13 and change million. And now with this section, the new estate and gift tax exemption amounts is 15 million going forward. And so basically the 15 million starts in 2026. So for 2025, we're still at I think it's 13.4 million, something like that. But going forward, it is 15 million. Now you'll notice there is nothing here about inflation adjustment. But I believe, if I remember correctly, that the clauses it's referencing already had inflation adjustments. So I don't think they need to restate that here. But yeah, so if you have a larger estate, then that is useful for you. And we're removing the uncertainty of people who were in that middle range, who would have been above the exemption under the old system, but below the exemption under the new system. Now we just have the new system because we don't have to worry about it reverting back between now and the time you pass. This is helpful for all the estate attorneys out there who are trying to plan for their clients. And I was talking to one client a couple weeks ago, and they were in that exemption range where maybe there would have been an issue under the old system. They could have barely started to get into that range, but under the new system, they're perfectly fine. And now we don't have to worry about it, which is great. All right, section 70107, extension of increased alternative minimum tax, exemption amounts, and modification of phase-out thresholds. So AMT, alternative minimum tax. So basically, AMT was originally designed, I think it came in the 86 tax reform, and what it was for was to prevent people who had high income from taking a whole lot of itemized deductions and then lowering their taxable income beyond what was fair or allowable or whatever kind of framing you want to put on that. And what Tax Cut and Jobs Act did was it raised the threshold of the income that was subject to AMT. However, AMT was also addressed in other ways because the things that were deductible under itemized deductions changed. We doubled the standard deduction, so fewer people are able to itemize. And then the mortgage interest deduction was capped. And then a lot of the other things like unreimbursed employee expenses, that got wiped out. Casualty losses outside of disaster areas, that got wiped out. So a lot of the things that people were able to itemize in the past that were subject to AMT restrictions disappeared anyways. So it's 6 of one, half a dozen of the other. But again, we're making it permanent as far as these changes. We are getting an inflation adjustment. And yeah, so basically AMT will be inflation adjusted, which is useful because it wasn't under the old system. And so it ended up catching more and more people. But again, the things that impacted AMT are less. I don't know how different things will actually end up being. All right, section 70108, extension and modification of limitation on deduction for qualified residence interest. So this is one of those things. This is where mortgage interest used to be uncapped, and then it was capped at 1 million, and then it was capped at 750,000. So if you, what I mean by that is that if you have a, I don't know, mortgages worth of a balance of 1.2 million, so the amounts over 750,000 of balance are not deductible. So let's say you have $1.2 million mortgage balance, you pay $50,000 worth of interest throughout the year. You're not going to be able to deduct $50,000 worth of interest on your taxes because of this clause right here. You have to apportion the interest that was paid, however much was under that $750,000 limit, and however much was above gets excluded. And yeah, a whole lot of effective changes. So this is going to apply in 2026. And yeah, so that rule stays basically. All right. Section 70109, extension and modification of limitation on casualty loss deduction. This one I really disagree with. So let's get into this a little bit. So we have all the date change stuff that we've seen. So removing the temporariness of Tax Cuts and Jobs Act and now making them permanent. And state declared disaster. Basically, if you have casualty losses, and casualty losses means, it used to mean theft or destruction. Now it basically just means some kind of loss in a declared disaster. And they are adding a new paragraph to include state declared disaster. So under the Tax Cuts and Jobs Act regime, it had to be a federally declared disaster, but now they're also including state declared disasters. I don't know how much difference there is between federally declared disasters and state declared disasters. I can't remember an incident of a state declaring a disaster and the federal not for that particular area, but maybe that's happened. It just hasn't come up in the ones that I've seen. But yeah, hurricanes, tornado, storm, high water, wind-driven water, tidal wave, tsunami, earthquake, volcanic eruption, landslide, mudslide, snowstorm, or drought, or regardless of any cause, any fire, flood, or explosion in any part of the state which the determination of the governor of such state or the mayor in the case of the District of Columbia and the secretary causes damage of sufficient severity and magnitude to warrant the application of rules in this section. So basically, if you have losses related to a disaster that is now either, as of 2026, now either federally declared or state declared, then you can deduct those losses in your itemized deductions to the extent that you're able to itemize anyways. How did that used to be? So under the old system before 2017, if a pipe broke in your house and you had losses that your insurance didn't cover, then that was a viable deduction that you could potentially take. If you had a bunch of stuff stolen, because they used to say theft and casualty, those were potential deductions that you could take on your taxes. But under the new system, it's only if you have losses and you're in one of these disaster areas. So like when the hurricanes blow through, a lot of times the whole state will be declared a disaster area, or sometimes multiple states. Sometimes it's county by county. And we'll have to see how the states, if they have any differentiation between federal and state declared disasters in 2026 and going forward. But by and large, you now have to have one of those external events rather than an internal event to your own property. So I personally am not a fan of that particular restriction. I think if you have a loss of some kind of property, then it's a loss, and you should be able to reconcile that on your taxes. But they didn't listen to me, so here we are with disaster-related casualty losses as opposed to general casualty losses. If this has affected you, then you've probably been familiar with the fact that this is externally related and not just theft or general casualty. All right, section 70110, termination of miscellaneous itemized deductions other than educator expenses. Again, changing the date of all these things, and the deduction allowed by section 162 for educator expenses as defined in subsection G, inclusion of coaches and certain non-athletic instructional equipment. Okay. Educator expenses, if you're a teacher, you're familiar with this, I'm sure, where you can get a Schedule 1 deduction of a few $100 worth of educational expenses, and apparently they're including athletic instructional equipment. And yeah, that's going to go into effect in 2026, once the Tax Cut and Jobs Act stuff expires. What used to happen? Termination of miscellaneous itemized deductions. So on Schedule A, there used to be a section at the bottom of miscellaneous, and that included a couple things. The most notable of which is probably unreimbursed employee expenses. So I've had people come to me and say, hey, I have a home office, so that's deductible, right? I said, let me ask you, is it home office for a job that you work at and you get a W-2, or is it home office for a business that you have of your own? And if they say, oh, it's for my W-2 jobs, then you're out of luck. It doesn't do anything because this section right here. So that those type of things where you work as an employee and you have your own expenses used to be deductible subject to a 2% AGI floor, blah, blah, blah. But part of the Tax Cuts and Jobs Act and now made permanent, those things are gone. If you are spending personal money for your employer or on behalf of your employer, get reimbursed or just realize that's money out of your pocket, reducing your net earnings. One of the two. So, all right, section 77111, limitation on tax benefit of itemized deductions. And in the case of an individual, the amount of itemized deductions otherwise allowable for taxable year shall be reduced by 2/37 of the lesser of such amount of itemized deductions or so much of the taxable income of the taxpayer for the taxable year determined without regard to this section and increased by such amount of itemized deductions as exceeds the dollar amount at which the 37% tax bracket would under section 1 begins with respect to the taxpayer. That's a whole lot of stuff. Coordination with other limitations. Limitation not deductible, not applicable to determination of deduction for qualified business income, which is section 199A type stuff. Patrons of specified agricultural and horticultural cooperatives. Very rarely see that. And obviously this kicks in at the end of 25 into 2026. So basically, if you are a high income earner and you have huge itemized deductions, then you're going to be limited on how much of those itemized you can actually use because they want to keep you in the 37% bracket, basically. So this affects very few people, but if you're a very higher income earner, then that's going to continue. Okay, so let's see. Section 70112, extension and modification of qualified transportation fringe benefits. Okay, a lot of striking subparagraph D of section 1 and paragraph 2 and inserting and inflation adjustments, which is always helpful, coordination of disallowance with certain expenses, and basically they're saying you can't deduct qualified transportation fringe benefits. That's not too common, could affect some people. Section 70113, extension and modification, a limitation on deduction and exclusion for moving expenses. So in the old days, again, this was the change back in 2017. If you moved at least 50 miles for work purposes, then your moving expenses were deductible. And they got rid of that at Tax Cuts and Jobs Act. And then this is continuing that and making it permanent. Now, there are several states that still allow for moving deductions. Also, there are some states that allow for 2106 expenses, which is that unreimbursed employee stuff. California, notably, is one of them that does allow for those deductions. Interestingly, California does not allow for HSA contribution deductions. It's just how they like to do things over there. This is going to continue and being made permanent, basically. Okay, so there's exceptions if you're in the intelligence community or if you're in reserves and what have you. And let's see. Section 70114, extension and modification of limitation on wagering losses. Okay, this one's kind of wild. In the old days, you would pay taxes on your net gambling winnings. So let's say you won $10,000 and you lost $15,000. You have a net $5,000 loss. You're not going to pay any taxes. Now, what it does do is it screws up your AGI because you show the winnings on the income side of things, and then the losses go into your itemized deductions. So especially with the larger standard deduction that we have now, it's harder to itemize. And so if people had gambling losses but were not able to itemize, that still hit them for a tax that they otherwise would have been able to deduct. But assuming that you are able to itemize, then gambling winnings, gambling losses net out to zero. You can't go below zero, and everything was fine. However, this is changing. So, for purposes of losses from wagering transactions, the amount allowed as a deduction for any taxable year, A, shall be equal to 90% of the amount of such losses during such taxable year, and B, shall be allowed only to the extent of the gains for such transactions during such taxable year. Special rule, for purposes of paragraph 1, the term losses from wagering transactions includes any deduction otherwise allowable under this chapter incurred in carrying on any wagering transaction, and this goes into effect 2026. Okay, so what does this mean? This means that, let's say you win $10,000 and you lose 15, you're going to be able to deduct 9. So you're going to pay tax no matter what on $1,000, on that 10% difference here between 90 and 100%. Now, if you do a lot of gambling, whether you win overall or not, most people don't, then this is going to hurt a lot because I've seen people with hundreds of thousands of dollars worth of gambling winnings. I've seen those same people with more than that in losses. But if you've got $300,000 worth of gambling winnings, then you're going to be paying taxes on 30,000 of that, no matter what, which is wild. So just know that going into it, that even if you lose overall, you're still going to be paying taxes on it, which is generally not what most people think of when they come to what's fair, but this is the new law of the land starting in 2026. All right, section 70115, extension and enhancement of increased limitation on contributions to ABLE accounts. So ABLE accounts are great. They're like Roth IRAs for disabled people. And let's see, effective date is 2026. And modified inflation adjustment, the adjustment made by subsection A1 shall apply to taxable years beginning after 2026 and going forward. This is great. And the Tax Cut and Jobs Act increased the amount that you could contribute, and that is going to continue. And the amounts that you can contribute are going to increase related to the cost of living adjustments. So great. Section 70116, extension and enhancement of Savers credit allowed for ABLE contributions. So the Savers credit is a tax credit that is given for retirement contributions, basically, but also for ABLE contributions. And in general, the term qualified retirement savings contributions means with respect to any taxable year, the sum of the amount of contributions made by the eligible individual during such taxable year to the ABLE account, of which such individual is the designated beneficiary. And in the case of any taxable year beginning before January 1st, 2027, which is going to be 2025, 2026, the amount of qualified retirement contributions as defined in section 219E made by the eligible individual in the amount of any elective deferrals of such individual and any elective deferral compensation by such individual under an eligible deferred compensation plan of an eligible employer described in section 457. So coordination with Secure 2.0 Act of 2022. Paragraph 1 of Section 103E of the Secure 2.0 Act of 2022 is repealed, and the Internal Revenue Code of 1986 shall be applied and administered as though such paragraph were never enacted. Okay, so Secure 2.0 Act was a big act that was passed in 2022, and let's see if we can get the code section there. Let me pause this for a second. All right, paragraph 1 of Section 103E of the Secure 2.0 Act of 2022 is repealed. This kind of sucks because this is Section 103, the Savers match. So in general, subchapter B of Chapter 65 is amended by adding at the end of the following new section, in general, allowance of match. So basically what this said was that if you were a low income earner and you contributed to retirement accounts, the government was going to kick in up to an extra $1,000 to your retirement account. That's what Section 103 was about, the Savers match. However, that is now gone. And it was set to kick in 2027, and now it's not going to happen. Let's see, which is unfortunate. Yeah, there is still a non-refundable credit, that is the Savers credit, but the change that was going to happen is now gone, which makes me sad because I had calculated that if you did that for kids who were on payroll, then that could grow to up to about $600,000 at retirement age. But now it's gone. All right, section 70117, extension of rollovers from qualified tuition programs to ABLE accounts permitted. So if you had a 529 plan, and ABLE accounts do come under the 529 framework, then you can roll over from an education plan into an ABLE account if somebody is disabled and qualified for ABLE accounts. Section 70118, extension of the treatment of certain individuals performing services in the Sinai Peninsula and enhancement to include additional areas. You'll see this in lots of tax bills, and you'll be thinking, what is this about? There are certain people in the Sinai Peninsula and other places, including Kenya, Mali, Burkina Faso, and Chad, included as hazardous duty areas. So this is not going to apply to many people outside of the military, but yeah, so they're adding some areas there. Section 70119, extension and modification of exclusion from gross income of student loans discharged on account of death or disability. Basically, in the case of an individual, gross income does not include any amount which, but for the subsection, would be includable in gross income for such taxable year by reason of discharge in whole or in part of any loan described in subparagraph B if such discharge was pursuant to subsection A or D of section 437 of the Higher Education Act 1965 or the parallel benefit under part D of title IV of such act pursuant to yada yada loans discharged. And basically, if, like it says up here, if your student loans are discharged because of death or disability, then you don't have to include that as part of your taxable income. So that's helpful. All right, and there's some caveats with that. That's the general thrust. Section 70120, limitation on individual deductions for certain state and local taxes. This is another big one. This was a huge argument between the House and the Senate. So in general, Section 164B6 is amended. One, by striking before, again, that's expiration date, by striking 10,000, 5,000 in case of married filing joint, married filing separate, and inserting the applicable limitation amount, half of the applicable limitation amount in the case of married individual filing separate. And the applicable limitation amount is set to be any taxable year beginning in calendar year 2025. So that does kick in this year, $40,000, and then 2026, 40,400, and 2026 through 2027 through 2029, 101% of the dollar amount in effect. So it's going to go from 40,000 to 40,400, and then another 1% higher, and then another 1% higher, at least for a few years. And beginning in 2030, we're back down to 10,000. So again, we have one of these sunset provisions, which I hate, but is what it is. Okay, so state and local taxes. If you are in a state that charges income tax, in the old days, we used to get unlimited deduction. So if I paid $50,000 to the state of California or the state of New York or whatever, I was able to include that as part of my itemized deductions. In the Tax Cut and Jobs Act, that was limited to 10,000 or 5,000 if you're married filing separate. Now, 2025 through 2029, it's going to be up to 40,000 and change with this 1% adjustment. However, there is an income limit to it. So phase down based on modified adjusted gross income. The applicable limitation shall be reduced by 30% of the excess of the taxpayer's modified adjusted gross income over the threshold amount, half the threshold amount for a married filing separate, and the threshold amount is for 2025 500,000, in 2026 505,000, and then that matching 1% rise with the 1% rise in the state and local tax deduction. Okay, the reduction shall not be reduced to less than 10,000. So if you're over $500,000 of income, modified adjusted gross income, then you're going to get at least $10,000 worth of state and local tax deduction, but it might be capped there. So if you're a high income earner, then that's going to hit you. But if you're in that in between area, then this will be somewhat useful. Okay, and for purposes of MAGI calculation, again, the same section that we saw back in the seniors calculations for modified adjusted gross income, and this goes into effect 2025 through 2029. Okay, the sunset going back to 10,000 in 2030 kind of sucks. It is possible that there would be future legislation to adjust that because, as we're seeing here, one Congress cannot force another Congress to do anything, basically. Whatever was written before in some previous law, a new Congress at that future date can write whatever they want, this entire bill, modifying previous legislation that was already done. Okay, for people in those high tax states, that's going to be useful because people who are high income earners in those states were paying well in excess of $10,000, and now they're going to be able to deduct a little bit more. But this was a big argument because it's like, by virtue of the fact that you're deducting state and local taxes, you are in effect reducing the tax burden of those people to live in those states. And so people in other states are saying, that's not fair. Why do I have to pay proportionally more because so-and-so in New York or New Jersey or any of these high tax areas, because they're getting bigger deductions on their federal taxes just by virtue of the fact that their states charge more? That is going to be, it has been a fight for a decade and will continue because now those people in those states got more of a break compared to what it was, at least for a few years. So that is the SALT cap adjustment. All right, and that brings us to the end of Chapter 1. If we go back to the table of contents here, Chapter 1 is providing permanent tax relief for middle-class families and workers. So basically, most of this was making the 2017 Tax Cut and Jobs Act permanent. And then Chapter 2 is all about delivering on presidential priorities to provide new middle-class tax relief. No tax on tips, overtime, car loan interest, Trump accounts, contribution pilot program. That'll be an interesting one. But we'll cover that next time because I am tired. Okay, so that's where we are. I'll leave it here, and then we'll see you next time.